In a surprising turn of events, gold prices have surged past $2,330 amid weakening U.S. inflation data and political instability in Europe, despite a hawkish tilt from the Federal Reserve. Investors are increasingly betting on potential interest rate cuts by the Fed later this year, driving demand for safe haven assets like gold. This rally occurs against a backdrop of falling U.S. Treasury yields and fluctuating consumer sentiment, highlighting a complex economic landscape fraught with uncertainty. Amid these turbulent times, one can't help but wonder, how will the interplay between global economic indicators and central bank policies shape the future of gold prices and broader market trends? Gold prices experienced a significant rally, soaring above $2,330 as weak inflation data in the United States raised hopes among investors that the Federal Reserve might cut interest rates later this year. This uptick in gold prices is also being driven by a heightened sense of risk aversion due to political turmoil in Europe, which has increased demand for safe haven assets like gold. During the North American trading session on Friday, the XAU/USD pair traded at $2,333, marking a gain of over 1.30% after rebounding from daily lows of $2,301. Despite a generally sour market sentiment, U.S. equities managed to recover slightly, with the Nasdaq gaining 0.28% and the S&P 500 trimming its earlier losses, ending the day just shy of flat at 0.10%. The latest data revealed a deterioration in U.S. consumer sentiment for June, with inflation expectations for both 1 and 5 years remaining above the Federal Reserve's 2% target. This data, coupled with earlier inflation reports, has buoyed investor optimism that the U.S. central bank might slash rates twice this year, instead of just once, as previously projected by policymakers. Traders. According to data from the Chicago Board of Trade, CBOT are now pricing in 39 basis points, BPs, of easing by December 2024. Additionally, the yield on the U.S. 10-year Treasury note fell by 3 BPs to 4.211%, providing a tailwind for gold, a non-yielding asset. This drop in yield occurred despite China's decision to pause its 18-month-long bullion purchasing spree, with the People's Bank of China holding steady at 72.80 million troy ounces of gold in May. Market dynamics continue to be influenced by the strength of the U.S. dollar. The U.S. dollar index, DXY, rose by 0.28% to 105.53, capping the upside for gold prices to some extent. In June, the University of Michigan's Consumer Sentiment Index fell to 65.6, down from 69.1. Missing the consensus estimate of 72 and marking the lowest level of sentiment in 7 months. Inflation expectations for the next 12 months are projected to remain unchanged at 3%, while the 5-year inflation expectations are anticipated to decrease to 3.1% from the previous 3.3%. Federal Reserve Chair Jerome Powell, in his recent statements, expressed less confidence in the progress on inflation, indicating that the central bank is prepared to respond if the job market weakens unexpectedly. He emphasized that while the recent US CPI report showed continuing disinflation, it is just one report, and the Fed needs to see a sustained deflationary trend to adjust its stance. Despite the weaker-than-expected U.S. CPI and PPI reports, the latest NFIB Small Business Optimism Index survey for May revealed that businesses are still grappling with higher prices and limited access to affordable financing. This ongoing struggle underscores the complex economic environment and its impact on various market segments. From a technical perspective, gold prices appear neutral to bearish. The head and shoulders chart pattern remains in place, suggesting potential downside ahead. Although there has been some recovery and momentum, the relative strength index, RSI, remains bearish, indicating that the recent uptrend could be short-lived and may pave the way for further losses. If gold prices manage to extend gains past the June 7 cycle high of $2,387, the next target would be the $2,400 mark. Conversely, a drop below $2,300 would see the first support level at the May 3 low of $2,277, followed by the March 21 high of $2,222. Further declines could see sellers aiming for the head and shoulders chart pattern objective around $2,170 to $2,160. As we navigate these uncertain times, the key question remains: how will the unfolding economic indicators and central bank actions influence the future trajectory of gold prices and the broader financial markets? Share your thoughts on this intricate dance between economic data and market reactions.